Great. So May 2016, question 1B. Planet Limited is considering undertaking a 20-year project which requires an initial investment of 250 million in a real estate partnership, and whose present value of expected cash flows is 254 million. Planet has the option to abandon the project anytime in the next 5 years for shillings 150. So that's an option to abandon. If you're abandoning, it's like you're selling. You're selling. The variance in the present value of the cash flows is 0.09. So that's the variance. And the 5-year risk-free rate is 7%. They want us to get the present value, the net present value of the project, including the option to abandon the project. Including the option to abandon the project. Then comment on the results, and you're given the hint, the Black-Scholes option pricing model. So this is about valuation of options using the Black-Scholes. And remember kwa options tuko na call option na tuko na put option. Call option, option to buy. Put option, option to sell. Abandoning, when I abandon, I'm not buying. When I'm abandoning, I'm scrapping it off, I'm selling. I'm doing away with it. When I'm doing away with it, I'm not buying, but it's like I'm disposing. So for that reason, this is an option to sell, which would be the put option. And the examiner gave us the leakage here. Akasema to get the call option, we take the PA. PA is like the what naita the spot price. Spot price. ND1, normal distribution of D1, minus PE. So ametumia tu PE na PA. Sometimes we use hapa tunatumia S to represent spot price, SND1 minus END2. E is the exercise price raised to power negative RT. So negative RT, sometimes because of the negative, we might opt to bring it hapa chini. Because the power being a negative, we can do END1 divided by exponential raised to power RT. To avoid your negative ya hapo juu inaletanga confusion. Where D1 is into bracket spot price over exercise price, PA ni spot price kwetu, PE ni exercise price, plus the risk-free rate of return plus 0.5 times standard deviation squared. Standard deviation squared is the variance times the time. Divide by the standard deviation times the square root of time. Then D2 becomes D1 minus the denominator of D1. Then the put option equals to the call option minus the spot price plus exercise price times exponential raised to power RT. Ama exercise price divided by exponential of RT. To avoid this one negative. So with all that, we just appreciate that since it involves an abandonment, so from interpretation point of view, it is a put option. It is a put option. Put option is the option to sell. Option to sell. And the value of the put option equals to hii denominator yetu hii ya chini hapa. So value of the call option, I can do plus ama nianze na minus. So minus So PA is our spot price. Let me call it S, plus the exercise price. The exercise price, I would prefer to divide by the, instead of doing exponential of RT, I can do divide by exponential raise to power RT, so that niweke kwa denominator, ni avoid hiyo negative. Now, the NPV of the project, including the option to abandon, our NPV, let me start it here. Our total NPV will be, we take our NPV the normal way, then we add the value of the put option. So our NPV, I can see we had the present value of expected cash flows ni 254, initial outlay ni 250. That will automatically give us the NPV, PVCI minus IO. So NPV is 4 million. We need to get the VP. So for us to get the VP, we need to start by getting the VC. Na VC tumepewa formula yake hapo, tukaambiwa kuwa value of the call option equals spot price. So SND1 minus END2. So ND2 divide by the exponential raise to power RT. I really like avoiding the negatives. That's why I'm not putting it kwa numerator. So I divide by so that I avoid the negative ya RT hiyo. Hiyo negative kusumbua watu. So N is about the normal distribution. Normal distribution of D1, which we shall check in the tables. So we need to get our D1. D1 equals, we have in into brackets, spot price over exercise price, then plus the risk-free rate of return, ameita R. Then I can do plus I can decide to do standard deviation squared divided by 2, because 0.5 is like a half. I can do, let me call it SD squared divided by 2. I think when I divide by 2 is like I'm doing 0.5 of SD squared, right?
Yes, yes.
Then that one I multiply by the time. And all these that I divide by standard deviation times square root of time. Sa square root inakuanga wapi hapa kwa keyboard? Acha niweke
weka tu time raised to power half.
Acha niweke SRT.
Instead of putting SRT, put T raised to power half.
Haya, sawa, we are learning.
It's the same.
It's okay, it's okay.
Yeah.
So raised to a half, that's okay. Great. So our spot price.
Adjust your volume sound liko chini kabisa.
That's okay. So our spot price iko sawa sasa?
Iko chini. Umetoa mdomo kwa microphone tena.
So the spot price, you can hear me now?
Yeah.
So the spot, the spot price is the price today. The spot price is the price today. So the Planet Limited is considering undertaking a 20-year, which requires an initial investment of 250, right? That's our spot price. Yes. Our exercise price, we can abandon it anytime in 5 years at an amount of how much? 150. 150. Do you have the risk-free rate?
7%.
The risk-free rate is 7%, that is 0.07. Time should always be in years. Is it 5 years? So time is 5 years.
Yeah, 5 years.
Do you have the standard deviation?
0.09.
We have the variance. So standard deviation squared ndo tumepewa, which is 0.09.
Yes.
0.09. So can we get our D1?
Yeah.
So I need the in. Spot price is 250 divided by exercise price of 150 plus the risk-free rate 0.07 plus standard deviation squared is 0.09 divided by 2, and this one I multiply by 5. And everything I divide by standard deviation. Say do the square root. The square root of standard deviation, that is 0.03. It's 0.3.
Yeah.
That's the square root of 0.09.
Yeah.
Times the square root of time, square root of 5.
2.24.
2.24. So unafinya kwa calc unapata D1. In umeona penye iko kwa calc?
Yeah, in shift in. Alpha in.
Hapana. In imeandikwa tu in white, so you just do where in is. So in, you open the brackets.
I get a figure of 0.5108.
5108. So that becomes the D1. Can we have the D2?
No, that is not
your
the
numerator.
Answer. That is no, that is just in.
Hiyo ni in peke yake.
Yes.
Haya, sawa. Get the answer basi.
Okay, na yote mweka.
1.6158.
Yes.
Haya, D2 nayo equals to D1 divided by its denominator. So this one will be equals to 1.6158 divide by the denominator of D1 si ni hii.
Yes. D1, D2. Is it not D1 minus? Is it divide or minus?
D1, D2.
D2. D2 is equals to D1 minus.
Or D1 minus. So D1 minus its denominator. So denominator is 0.03. 0.3 times 2.24. So that equals to
0.672.
0.6
72.
672.
Yes.
Can we have the normal distribution of D1? Now, huku kwa options, when D1 or D2 is a positive,
Yes.
when it's a positive, then our normal distribution is 0.5 plus. I don't know if this sitting has the normal distribution.
No, that answer is not 0.6. Now, the final answer of D2 is 0.9438.
0.9?
438.
9438. Aya, sawa. So I was saying that, just trying to check if this sitting has the normal distribution table.
Yeah, it does.
Good. Good. So I'm saying that if D1 is a positive or D2 is a positive, then inamaanisha our ND1 is 0.5 plus, is more than 0.5. If it is negative, then it is less than 0.5. Okay. So if it's a positive, it is 0.5 plus. If it's a negative, 0.5 minus. If it's a negative, it's less than 0.5. If it's positive, then it's greater than 0.5. It's positive, it's more than a half of this table. If it's negative, it's less than a half of this table side ingine. In our case, they are both positive, sindio?
Yes.
So therefore, our ND1 becomes 0.5 plus, because the shaded region is only the quarter, so we take the 0.5 plus what we get in that quarter. So it is 1.62. 1.62. Are you having this? 0.44?
Yes.
Is it 0. 0.
3554.
Is it 3554? I'm seeing 1.61. Manza na hiyo ingine. So 1.6.
We come to 1, then
1.62. So uko hapa na 1.6. 1.6 alafu 2. Umeiona?
Yeah, 0.4474.
0.4474. So that one would be equals to 0.9474.
Yes, 0.9474.
Can we have our ND1? ND2 yes. Now? It is so also 0. So 0.5 plus
0.94.
So it is a 0.9.
3264.
3264. So 0.3264, which equals to 0.8264.
8264. Yes.
8264. So therefore, can we have now our VC?
Yes, we can have our VC.
So spot price is 250. times ND1. ND1 is 0.9474 minus exercise price, is it 150?
Yes.
150 times ND2, 0.8264. 8264 divide by the exponential raised to power RT. Raise, our R is ngapi, or is the risk-free rate of return? 0.05, 0.07 times time, which is 5. Have you seen where exponential is in the calculator?
Yeah.
Hapo penye kuna in, but you start with shift.
Shift in. Yeah, it gives 2.7183.
So umefinya shift ukapata.
And shift in, then it's equals to.
Great. Then you do hapo usha raise, by the way. So hapo shift ni ya ku raise. So I wish ungefinya to shift in.
Or shift in,
Then open the bracket, 0.07 times 5, close the brackets.
I don't raise it. I should raise it.
No. Ukiangalia ya shift, ukiangalia hapo juu ya in, what is in yellow is already E raised to.
But umefinya pink.
Umefinya?
Pink.
Unaona hapo kwa in?
I use the shift.
Yeah, which is okay. Ukitumia shift, see shift is in yellow.
Yes.
Hapo juu ya in, what is the explanation of in? What is in yellow, imesema it is E raised to.
Yeah, nimeshafanya hivyo.
What is in red, imesema tu E. So ukitumia alpha,
to confirm whether they're giving the same.
Ukitumia alpha is when you'll raise to.
Yeah.
Because alpha only gives you in, not in raised to. Shift is what gives you in raised to.
In raised to. The answers are the same, I've confirmed.
Exactly.
Shift or alpha.
Yes. So I always like shift, because shift you don't have to raise to again.
To raise to again. So
you simply do shift in, open the bracket, 0.07 times 5, close the brackets.
I'll see.
And that will be your denominator, isn't it?
Yeah.
So that you can do 150 times 0.8264 divide by answer. Then you also do 250 times 0.9474 minus your answer. You get your VC.
VC is 149.50.
149.50. What of now the VP?
50 is equal to VC minus S plus E.
So VC, which is 149.50.
149.50.
Minus the spot price, which is 250.
250
plus
150, which is exercise price.
the exercise price, which is 150, divide by Cindy.
But this one we had calculated to be 1.4191.
She calculate 1.1419.
1.4191.
4191.
No, 1.4191. Yeah, that way.
So do we have the VP? So for clarity, I can put this one in brackets.
So I use board mass.
Still okay.
All the answer will just be the same.
It should be the same. Bora iweke kwa brackets.
I think board mass will give me that answer better. So it is 5.200 or 5.200.
5.200.
008.
5.2.
Yeah, it's 5.2.
And remember that is million. It's positive, right?
Million. Yes, it's positive.
So therefore, total NPV equals present value of cash inflows. Was it 254?
Which one?
The present value of cash inflows of that question?
254.
It was 254, right? And the initial outlay was 250.
Yeah.
India.
Mm.
So minus 250. Yeah, 254. The initial outlay is 250, so minus 250. Then all these we add. So plus the value of the put option, which is 5.2. So our total NPV becomes, is it 9.2?
9.2.
So that is the 10 marks.
Wow, so the only problem here is to know the formula and to know which one is a spot rate and which one is exercise rate. Then
Exactly. Interpretation.
Yeah.
Ni ngumu sana mtu angegundua kuwa hii ni valuation ya options.
Ni ngumu sana. Kama ungepewa hii black shot.
Especially kama ya ingekuwa hapo, watu wengi sana wangeshangaa what has been asked here.
Yeah.
Then of course, comment on the results of your analysis in B1 above. The project should be abandoned since it is more profitable.
Yeah, it's more profitable.
I think that's okay. Can go to question 4.
Yes. Mwalimu, can we add a day in our timetable? I don't know how fixed you are. If you can get a day even for an hour, because that Thursday class, what time haiendi vizuri sana.
We'll try and see how we can adjust.
Tuko tu na 3 weeks and I don't want to nini this time or to fail this paper again. I want to pass this paper.
Don't panic.
That's not about anifanyia tena character development.
Watakufanyia ile kitu.
Just MC mchezo.
It shall be well. We'll see. We'll see.
Okay, you're still recording. After class.
You don't want to be recorded. Question 4.
Question 4.
Huge Limited intends to take over Tiny Limited, another company in the same industry. So Huge is the predator, Tiny is the target, right?
Yes.
Then you're told that Tiny Limited is expected to post earnings of 86 million next year. That is our expected earnings from the target firm. If Huge Limited acquires Tiny Limited, the expected results of Tiny Limited for the next 3 years will be as follows. So you have the sales in year 1 paka year 3, cash costs or expenses, capital allowance ni sawa na depreciation, interest charges, cash to replace assets and finance growth. So cash to replace assets and finance growth ni kama retained earnings. What you retain in the company for growth and replacement of assets. That is investment. So ukishapata hiyo, whatever remains is the dividends. Then from year 4 onwards, it's expected that the annual cash flows from Tiny Limited will increase by 4% each year into perpetuity. Tax payable at the rate of 30% and is paid in the same year the profits to which it relates are earned. Then if Huge acquires Tiny, it estimates that the gearing after the acquisition will be 35%, measured as the value of debt as a proportion of total equity and debt. So meaning debt will be 35, equity will be the difference, 65.
Yes.
After the acquisition of Tiny Limited, Huge would have a cost of debt of 7.4% before tax and a beta of 1.6. RF is 6%, return on the market portfolio is 11%. For 2 marks, the offer price for Tiny Limited, if Huge Limited were to value Tiny on a forward price earnings ratio multiple of 8 times. So the value, the offer price, how much are you going to value, to pay? So in answering number 1, offer price would be equals to value of Tiny. Value of Tiny Limited, which equals to PE ratio times expected earnings. Expected earnings. Remember the PE ratio valuation model? The value of the firm can be the PE ratio times the earnings.
Expected earnings.
Our PE ratio amesema ni 8, right?
Ni 8 times. 0.8 times.
Na expected earnings ni ngapi hapa juu? Have you seen 86 million? Is expected to post earnings of 86 million next year. So hiyo inatupea 2 marks.
688.
688.
Yes.
So there you go.
Showing.
That is part 1. That's okay. Can you get part 2?
Yes, part 2.
The WS for
Average.
the worker after the acquisition. Work equals to Weke plus
WDKD adjusted for tax.
1 minus T. We have the weight of equity 0.65. Is it?
Now, Mwalimu, equity should be 0.35 and debt 0.65.
It estimates that the gearing after the acquisition, gearing is debt where we need.
Gearing after acquisition will be 15% of the value of debt as a portion of equity is 0.65.
Gearing is debt. Gearing is debt. So equity is 0.65 na KE wamesema, so tuanze na kutafuta KE kwanza. Tutoke hapa.
Yeah, tutafute kero.
So KE equals to RF.
We are not using
plus,
the risk premium. KL is equal to KU plus KU minus KD. Are we not using that one?
We are not looking for the bay because we've not been told that this one is bar.
No, not
We just
bay.
told.
We are looking for CAL, cost of equity. Are we not using that? Risk premium.
Risk premium.
Yeah, yeah.
We are not in. We are not in. We are not in MM2. And now, if you use that one, let me ask, what is KEU?
KEU.
Hakuna. Hakuna? Hapa tuko kwa MM2. So RM minus RF times the beta. Ndio.
Yes.
RF is ngapi?
RF is 6%.
So 6 plus return on the market is 11.
11.
So 11 minus 6 and beta
5.
is
1.6.
So do we have as our KE?
We have 14%.
14%. So therefore, work equals to the weight of equity is 0.65 times 14 plus, is it 0.35?
Yes.
Times pre-tax KD was 7.4.
7.4.
7.4 adjusted for tax. Can I do 0.7?
Yes. Work is 10.91.
So 10.91. If we love the calculator, at least this one is very close to 11. You can say 11%. So those are the two marks.
Now part 3.
The offer price using discounted cash flows. So discounted cash flows, first of all, we look for those cash flows. Hizi ziko hapa, ni kutengeneza the normal cash flows we have year 1, year 2, year 3. So figures are in thousands of shillings. So we have sales. $20,000. I can put it in millions instead of thousands. So sales in year 1 is 200, 280, and 320.
Yes.
We less the costs. So costs in year 1 is 120. I can put it in brackets. In year 2 is 160. And in year 3 have 180. We also less interest. The capital allowance to add the DTS. So interest is 10, 10, 10. So negative 10, negative 10, negative 10. So I think at that point, we can have our pre-tax cash flows. Which is the difference, ndio?
Year one is 70.
70,
Year two, 110.
110,
Year three is 130.
130.
Yes.
So at that point, we can less the tax. Then we add the DTS. Tax is 30%, as we were told, right?
We were not told anything about that.
Ndio hii.
Copy.
Tax is
Oh,
payable at the rate of
yeah.
30%.
Yes.
So 3 times 7 is 21.
21.
This is 33. And this is the other one.
33.
How much?
39.
39. So let me make them. So hapa ni 39 minus 39. So this is minus. This is also minus. Then we add the DTS. The capital allowance tax shield. So we take our capital allowance times 30%. 30% times the capital allowance.
Six in year one.
Year one is 6.
Year two is 9.
9. And finally,
12.
12. So we have our net cash flows. Which is the summation of that. So 70 minus 21
55.
plus 6. How much?
55.
55.
Yes.
Year 2.
86.
86. Year 3.
103.
103.
Yes.
Then at that point, we can less our capital investment. So cash to
Are we not
replace.
discounting? Are we not discounting?
We've not yet gotten the net cash flows, the discounted. We less, first of all, this is like the retained earnings. We need to get the dividends.
Okay.
So also less that cash to invest. Let me just call it cash to invest. In year one, we need 25 to invest.
25.
So minus 25. In year two, we need 30. In year three, we need 35. So whatever we have now is now our, let me call it the net cash flows, or I can call it the dividends. Net cash flows, which is like now our dividends. This is 30.
Yes, that is 30.
This is 56.
56.
And finally,
And that one is 68.
68.
Yes.
Sasa hizo, sasa tunaweza discount. So here now I can put my PVIF. Was it 11% the cost of capital? 10.91, we rounded it off to 11%. So 11% 1 year.
0.9009.
So 0.9009 year 2.
0.8116.
8116 year 3.
0.7312.
7312. So that is
Present
our
value year 1 is 0.27.2027.
weka yote mara moja.
Okay. Unataka nini? Chai. Ocheng biona nanya pili chai. Nanya kama usta.
So 30 times this
Total
plus 56 times this.
122.
122.
198.
122.
0.1 or 20.1982.
0.20. Then we add present value immediately after stability. Remember the valuation of ordinary shares? Supernormal growth farm. Ile tulikuwa tunafanya DO into 1 plus G.
Yeah. Yes, yeah.
We divide by so we divide by, this time round we divide by WSCC minus the G. So zile dividends tuko nazo after stability is 68, si ndio?
Yeah.
So from year 4 they'll grow at 4%.
4%.
1.04. Then we divide by
11 minus 0.
our WSC is 0.11 minus 0.04.
0.11, yes.
So what do we have there?
We get to 10.29.
10.29. Sasa tuki-add hizo mbili is when now we get our total value.
So that one we don't discount. I think this one we should discount.
Oh, we've already we are supposed to discount.
Yeah, we've not
so this one is 10.29
times 0.7312.
Yes. Times 0.7312.
It gives us 738.72.
We get?
We get 738.72.
Good. So the total of the two becomes the offer price.
860.92.
860.92.
Yes. This question was hard.
It was a tough one.
Yeah, rush. Hii 10 marks hata ingeenda tu singefanya hata.
Hii ukiona iko hivi, kwanza margins yenye iko na hizi. Hiyo inakuanga free marks. Tengeneza income statement ya kawaida.
Hata nimeshajua sasa.
We have several questions naulizwa hivyo. So the offer price is about the value of the target farm. What is the value of the target farm? So hapo waliuliza valuation in two ways. Waliuliza valuation, ways of valuing the target farm. We have the PE ratio, which is required number 1. And we have the discounted cash flows. Discounted free cash flows, number 2. Number 3, sorry. think that's okay.
That is done. This sitting is now done.
So
You
our
still have time, Mama. I want to. You still have time, Mama. Unaenda meeting.
nafaa nikuwe meeting 4:30. Naona watu wanaanza kuniulizia. But nini, our next sitting is hiyo inafuata.
Hatujafanya May 2015.
May 2015 haiko kwa hii past paper. Uko na May 2015?
Niko nayo.
Hiyo past paper yangu sijui niliipeleka wapi.
Ama tuendelee mbele tu, tuache kama una hiyo past paper. Tuende November 2016.
Tunaweza acha yenye inakuja.
Na September uko nayo 2015.
September niko nayo.
We can move to September, then I will scan this May 2015. I send it to you. No, I'll just send the whole paper from 2010 to.
Yeah, you can send the whole paper. You can send the whole paper.
I'll send from deck to 7. I think I have from deck to 7.
Sawa. Yeah. Thank you. So we are targeting May 2015 or September?
September. So we are moving upwards now. Or we can target May. We go back to May, then we come to September.
We can do May 2015. That was examinable. September ilikuwa na errors mingi. So you'll kindly scan from, you'll kindly share the paper. Hata kama ni saizi ndio usisahau. Then anza kuipitia.
Naenda kupitia, so the only penye nitapata challenge ya tutafanya.
Sawa.
Okay.
Sijui
Like
nitapata
question 5 hata nimeshaona hata nitapata challenge in question 5.
Ya May 2015.
Money market hii